Hello and welcome back to Charts and Numbers with Maurice Wilson. This is a special after the Fed meeting edition for November 1st, 2023. If you haven't seen one of my videos before, I do a number of series. One is Charts and Numbers and one is Let's Run the Numbers. And so in Charts and Numbers, I combine stock market charts with numbers from Main Street to kind of give you an overview of what's going on, hopefully provide some clarity for clients and those interested in our firm alike. This is a client edition video, so I don't have normal bells and whistles. I wanted to get this to you guys as quickly as possible so that you can have it going into the weekend. So let's jump into it. As I said earlier, this is an after Fed edition. And for those of you who don't know, my name is Maurice L. Wilson. That's a picture of me. I'm on LinkedIn. Probably seen me on some of your statements. So yeah, this is Charts and Numbers. A little self-plug there. So as I said earlier, the Fed has just announced November 1st today that they're going to leave the rates unchanged. And for those of you who may not be following the Federal Reserve and what they do, are the rates you receive at the bank, the rates you pay on your interest or your debt, your credit cards, student loans. Those are all based on the Federal Reserve's rate that they peg. And their job is to keep inflation at a certain number, keep unemployment at a certain number. And they have various tools to do that. And one of them is their ability to raise our primary lending rate, which affects a number of things that we do financially. And so they've been raising that rate to fight inflation. And today they announced they're going to pause that rate increase and take a look around. So let's look at what it looks like when the Fed is doing their job. Some of you have been on my other podcast or video, so you've seen this chart before, but this is a chart of the Consumer Price Index, and it takes into account all of these categories you see here: food away from home, gasoline, apparel, medical care, shelter. It factors in the price of all these goods. And what this chart here is a 20-year rolling look at inflation. So this red line is the Consumer Price Index, basically what you and I pay for stuff. And what the Federal Reserve wants to do is they want to keep that rate about at this red line or below. When it gets higher, they get a little nervous, things start to get more expensive, and they have to go to work. So in this case, you can see here, let me get my pointer off. You can see here where coming out of the pandemic, our inflation shot up to 9.1% on a rolling 12-month basis. So you were feeling a lot of pain at the pump, a lot of pain in the grocery stores. Of course, housing prices have been really high. So the Federal Reserve in 2022 really went to work. So I'm going to bracket off 2022 here. It's about right here to right here. So the Federal Reserve really went to work on getting that right. And I'm going to get that last chart. It's not quite right. About right here is where the Federal Reserve really started raising rates and combating inflation. They've been doing that since about the start of last year. And this is the first month where they have taken a pause. Now, you'll notice that we have fought inflation and brought it down here. This is during the housing crisis, and inadvertently here during the pandemic. Now, what's key to note is when inflation has fallen down, you'll see these gray areas. These gray areas highlight recessions, and you'll see that right there where they say the gray area is a recession. And so we're going to talk about that more in this presentation and what that means for the stock market, what that means for the Main Street, jobs, things of that nature. But that is what the Federal Reserve is doing. They're trying to get that burgundy line there that's floating around here. They're trying to get that down up under this red line I've drawn here. And you can see they've definitely taken this 9.1 down to about 3.7. We're going to get the October read pretty soon here, now that we're in the month of November. And they've decided to wait and see, okay, have we done enough? what's next? What can we do? And so if you had to give the Fed a grade, I would say that I would give them an A plus on what they're doing. So let's get back over to our presentation here. So again, the key for what the Fed is trying to do is to get these interest rates down without basically causing a recession. So a recession is two negative quarters of GDP, or gross domestic product. And that's basically, think of GDP as if you're in sports, total yards in football. If you're in basketball, total points scored, like your output, what can you do? And so when the economic engine of the US is pumping really good, the GDP is typically 3% or higher. Now you'll see here, for context, this right here is the quarter, and really both these quarters, of the Great Reset. I'm sorry, the pandemic, back when we shut everything down in January, or basically, I think, March and April. So the first 2 quarters of the year, we shut everything down and everything pretty much went off a cliff. And then you can see when we open back up, GDP shot up. And so that kind of gives you an idea of what GDP is measuring. So when you have what you had here in the first 2 quarters of 2022, a negative GDP, well, historically speaking, that has been deemed a recession. And you see it here. This is going to be your Great Recession. And we don't go as far back into the .com, but you remember the Great Recession, housing prices, businesses going out of business, credit was really tight. And so you had negative GDP there, and that was another recession. So the thing is, even with all of that, when we had this period of back-to-back negative GDP growth, this period here, a funny thing happened. They actually decided that wasn't a recession. They called it a technical recession. And we're going to talk about how that plays into the market towards the end of this presentation. But it was one of the first times where we had negative GDP growth 2 quarters in a row. And you'll see where they reference that in the article. Yeah, second quarter in a row. But they called it a technical recession, which is just interesting. Now, some people said they were playing politics. It wasn't an election year, but the Democrats caught a lot of flack for it. Of course, Republicans use it as a talking point. You know how these things go. I don't really care about the politics. I'm not saying both sides are the same. I'm just not here to provide political commentary. You got your vote, do what you want to do. But they did call it a technical recession. And so that was interesting. Now, another interesting point is when the Federal Reserve goes on these rate hikes, when they are raising rates, as they say here, raising rates to combat inflation. Only once in the last 9 times they've done these rate hikes, or really since 1961, only once have they been able to lower inflation without triggering a recession. Now, if you're starting to put this together, we had a technical recession in 2022, but technical meaning that it wasn't really a recession. So far, the Federal Reserve has lowered interest rates without technically causing a recession, if that makes any sense. And we're going somewhere with all of this. So right now, Federal Reserve is doing a good job. They brought inflation down from 9.1% down to under 4%. They're trying to get it down to 2%. This is the 10th time that they're trying to do this. The last 9 times, they've only done it once without triggering a recession. So let's get back into the Fed a little bit here. So like I said before, since 1961, they've been trying to lower inflation 9 different times. They've only pulled off one time in 1994 where they achieved this soft landing where they didn't trigger a recession. And recessions are bad. People lose jobs. Companies go out of business. It's not something we want to go through. So if we can avoid a recession and bring down inflation, well, that's what we would call a soft landing, and that's what the Fed is going for. So Where does this lead the stock market? Because I'm not here to make you an economist. I'm not an economist. And economic theory and practice and application are just, voodoo science. It's very opaque. But what we care about is the stock market. So where does this lead the stock market? So what I want to do is highlight what happened last year. So last year, the market fell 25% from January through this, let's say around this time last year. So start of last year through around Thanksgiving, the market went down 25%. And then right now, we had a fall from the start of September through last Friday. The market had fallen 10% into what we call correction territory. So the market fell 25% last year, and then bounced and recovered through the end of August of this year, and then fell 10%. And that's what's been causing a lot of pain. And I've done some other videos about, have we reached the bottom? Is fear taking over the market? We're in the midst of all of that right now. We've had a nice little bounce, as I suspected, right here, starting Monday, because I just think we got oversold. But does that mean that we are done falling? And right now we're trying to say, okay, the Federal Reserve, they come in, they've done a good job. They dropped inflation from 9% to under 4%. They had a technical recession last year. The markets have responded really well this year, but we have dropped 10% and recovered a little bit. So where does that leave us in the market? Well, what I like to look at, and my background's engineering, so I'm always looking for, we can't call them facts in the market, but we're looking for trends. We're looking for, if this happened this time, what happened the last time this happened? And what I want to focus on is this right here. Because the market tends to have 10% declines a lot, but these 20% declines, you want to pay attention to those because that doesn't happen a lot. So what I wanted to do was I did a search, and with this AI stuff, you can really find out a lot. Really makes my job easier. You have to fact check it, but it really makes it easy to kind of put videos like this together. So according to the research, these 20% declines don't happen a lot. And they're saying every 7 years, but it's very interesting because you can get 10 to 20% declines that happen a little more frequently. Now, 10 to 20% and 20% or greater are almost the same thing. So I included both stats. And so what they're saying here is that the declines that are over 10 but less than 20 happen very frequently. And then the declines that are over 20% don't happen very frequently, every 7 years. So what I did was, of course, we want to find out what happened the last time we had these types of declines. Is I pulled up some history. So we want to go back to the dot-com bubble. So we're looking at, pulling out my chart here, we're looking at the 2000 through 2003 start of this century. And we're looking at that dot-com bubble, pets.com. You guys remember that. All the dot-com companies just going out of business, a lot of pain on the streets. And I wanted to look at that period. And in that period, you had a 20% decline in 2001, 20% or more. And then you had a consecutive annual decline in 2001 of 20%. And so then we look to the other big period. Now, overall, that market from here to here was a 50% decline overall. But within that decline, you had two back-to-back annual declines to 20%, just for context. So then I want to look at the Great Recession. And in the Great Recession, you had a 20% decline in 2008, and then you had a 20% decline in 2009. And the Great Recession, if you remember, credit got tight. They thought money markets weren't going to make it. A number of banks blew up. And so you had these 20% declines in the market reflecting that. And again, for greater context, you did have the market fall from here to about here, and that was a 50% decline as well. Now, I'm showing you this for a reason. On the previous chart, they said, well, these 20% or greater declines happen every 7 years. And that is true when you pull back the veil and look back over a 50+ year window. But in practice, when you have these bear markets, these bad markets, these 20% declines actually happen kind of back to back, right? because how else are you going to get a 50% decline if you don't have declines of 20% or more pretty frequently? So what I kind of surmised was, yes, you have these 10 to 20% declines every 2.5 years and these 20 to 40% declines every 8.5 years. But in the event of bear markets, the math changes and you actually have more frequent 20% declines, which is where you're having that pain at. So what does this have to do for the market? All right, well, one thing that I talked about in another video is you just, for the month of October, August, September, October, you had negative monthly declines. So the S&P 500, which is how we measure the stock market, fell each month. Well, that's pretty rare. So those of you who saw my Is This the Bottom chart, it's pretty rare for the market to go down 3 consecutive months. So since 1970, right here, the market has had 3 negative consecutive months only 17 times. So out of 322 possible consecutive months, 17 times has the market fallen 3 months in a row. And from there, it gets even rarer. So if we fall for the month of November, that will be the 5th time that's happened since 1970. And just going through this chart, you're getting into the low single digits for us to have back to back to back to back negative months, meaning that, well, we should have a positive November, right? We've already started off on a positive note. And so that bodes well for where the market's headed next. I just went through the back-to-back annual declines of 20% or more. That's very rare unless we're in a bear market. And that is kind of where we are on this 50-50 kind of way of looking at the market on November 1st, 2023, because the Fed is bringing down these interest rates. And historically speaking, 8 out of 9 times, the only way you brought down high inflation is with a recession. Now, and that's what's shown here on these charts. These gray areas are recessions, to bring down that high interest rate. So the way to look at the market is, if this technical recession that we had back in 2022, if that's a real recession, well, then we would have to have another recession to technically have another 20% decline in the market, because that's what happens when the markets go down. When markets go down, we get these, when recessions happen, we get these double-digit declines in the market. So again, if this is a fake recession, then the market could go down 20% or more. But if it was a real recession, then we're probably not going to have another 20% decline. In fact, we may have already had the recession that the Fed wanted and still had the soft landing. And so when stock markets have recessions, and look at these definitions. So at the beginning of the recession, there's a big decline in the market. That was that 25% decline last year. These recessions typically last less than a year. Well, the market started rising up at the end of last year. The recession lasted less than a year. It was the first 2 quarters of 2022. And then after a recession, the market typically does about 15%. Well, before the market went down 10% starting in September, the market was on its way to about a 10, 12, 15% gain. We don't really know because it was rising through the end of summer and then it fell off a cliff. So if you ask me what's next for the market, it really depends on if we had a real recession last year. So if we're putting it together, the Fed needs recessions to knock down high inflation, but they don't want to have recessions because recessions are painful. We had a technical recession in 2022. We had back-to-back quarters of negative growth in the first and second quarter of 2022. We also had a stock market that went down 25% in 2022. So in a way, if that was our recession, and we also had our interest rates or our inflation go down from 9-something% to under 4%. So our inflation went down. If that was our recession, then we probably bottomed. If we didn't have an authentic recession last year, then it's reasonable for you to expect that the market will return to the depths of the 2022 sell-off. And right now, we just don't know, which is happens a lot when you're studying these charts and markets. You get a great look at the past. Hindsight is always 2020, but it never gives you conclusive proof as to what's going to happen yet, but it does give you some context of what to expect. So what can we expect? Hey, we got to keep our eye on these GDP numbers and see what happens for the third quarter of 2022. Keep our eye on the market. But I feel pretty good that we probably have bottomed and we're heading on our way up. But only time will tell. So hopefully this helps out. If you have any questions, feel free to reach out to me. This is Charts and Numbers with Maurice L. Wilson. You have my email, you have my number. Thank you for listening. If you have any questions, just reach out to me. Thank you.